A stablecoin issuer is again a financial institution. It's a new type of a bank. It doesn't take deposits. It does take the underlying asset, but it gives you a coin that represents that.
Hello and welcome to another edition of Capital Calculus. I am your host, Anil Padmanabhan. A few weeks ago, President Donald Trump signed the Genius Act into law. This acronym stands for Guiding and Establishing National Innovation for US Stablecoins. It's the first big crypto legislation passed by the US Congress. It sets the stage for the formal adoption and rollout of stablecoins. Unlike bitcoins, stablecoins are backed by currencies like, in this instance, the US dollar or the US Treasury. Not only does it make it liquid, it's also less volatile compared to bitcoins. Stablecoins, like bitcoins, use the blockchain technology to enable payments in a real-time basis, both within the country and cross-border. Not surprising then that stablecoins are gaining currency rapidly over the last few years. At this point, they are still only a fraction of global financial transactions. But if this momentum is sustained, they pose a major disruption and challenge to legacy banking. What then does this mean for the world economy, which is still in the throes of the disruption posed by the adoption of artificial intelligence? What does it mean for countries like India, which have been reluctant to take to the stablecoin? To answer all this and more, we have with us today Bhaskar Dasgupta. He's a veteran banker based out of Abu Dhabi and wears many hats. One of them is as the chair of the Middle East Stablecoin Association. It's an entity which is working very closely with the government of UAE to roll out stablecoins. Welcome, Bhaskar.
Thank you very much for inviting me, my friend.
So, Bhaskar, I wanted to begin with this Genius Act, which the US Congress just passed. Presumably, it will accelerate the adoption of stablecoins in the US. But a basic question for our viewers, what are stable coins and are they a safe and reliable medium of exchange like, say, currencies?
Well, I don't know when was the last time, my friend, you actually used an actual currency note. But I think very few people these days are actually looking at currency notes. I mean, I forget to carry my wallet around. Why? Simply because, you know what, on our phones, you have everything. It is electronic currency. And especially if I know you have a large readership as it should be with your esteemed background, with the UPI and the entire tech stack that we have got. Very few people actually carry cash. Everything is just you scan the QR code or you tap and off you go. So in effect, our currencies are already digital. Now, if I look at a rupee or a dirham or a US dollar, and if I look at the currency note, sometimes it says, I promise to pay the bearer the sum of 1 rupee. You might have remembered it. These days, the kids don't even remember that. But for people of at least my vintage, we remember that. And if I take it to a bank or the central bank, they're going to give me an exactly the same note. If it is a 100 rupee note, if I take it to the bank, they will give me another 100 rupee note. So it's nothing but a piece of paper. But what it is backed by at this moment is the promise of the government that there is value related to 100 rupees, 100 dirhams, $100, or the case might be. And interestingly, in the US dollar, it's written in God we trust. So literally, what backs a currency, a fiat currency, is trust in the economy. Uh, it wasn't like that far back. I mean, previously it used to be gold backed, but then that started to go away, and then sort of from the 70s, 1970s onwards, it removed. So right now it's only backed by the trust in the economy and the government. So far, so good. So what we have is a currency, let's say, representation in an electronic format on your phone, which is backed by trust in God and in the country. So far, so good. But what's happening is that because of the structure that we had, there were quite a lot of inefficiencies, which I'm sure we will go deeper into. So one of the things that people have started to come up with on a private basis is, if I have a unit of currency, a coin, and if it is backed 1 to 1 with a fiat currency, that might be US dollars, that could be euro, it could be, frankly, lots of other things as well. As long as the value is fixed, then I can start using that for economic transactions. So a stable coin, if you divide that into two, is 2 words. The coin represents a unit of financial transactions, and stable relates to the fact that every coin is backed 1 to 1 by an underlying equivalent currency. So that's what stable coins are.
So I really like the word you use, trust, which is the critical part in any currency. So in what you're saying is that this trust can be transferred to a digital currency like a stable coin?
That is correct. I mean, I just gave you an example. If you go back literally 100 years back, much of our currencies were actually backed by gold. So you could actually take your currency and you could go to a bank and they would give you a relevant amount of gold, actual gold, right? And then we broke the link. And then, as I said, it was just based upon trust. Trust me. But now it is back to being backed by something that is again tangible, well, digitally tangible. So if you ever wanted to, you can do the transactions, but if you actually wanted to uh, trust, then you can always go to the issuer, who now doesn't need to be the government, and say, I want the backing, the trust. They're going to say, no worries, give me your bank account. I will transfer fiat currency, or I can transfer units of money market funds, etc., to you. That's fine. So the trust is, it is redeemable. It is redeemable on demand. It is convenient. It has to be convenient. It can be transferable and exchangeable. And there should be independent checks that, it's like Eisenhower said, trust but verify, right? So the verification is there from an independent source who says, you know what, this guy is issuing a coin, and we guarantee that he does have the 1 to 1 relationship in the underlying asset.
So it also checks the box of interoperability. So I presume now that it checks all the boxes of a currency, then it has the added advantage that you don't have to physically carry it out around with you. And of course, as I said in the intro, it is based on blockchain and enables real-time payments. So it becomes a very attractive form of medium of exchange, especially since the costs are pretty low. So what does this mean for legacy banking, where today if I was to say transfer money from Dubai to India, I may transfer 100 dirhams, probably I lose 5 dirhams to both the local bank as well as the State Bank of India in India. So with if I do it through Bitcoin, probably it'll probably shaving off in 0.00%, or what do you feel?
So, my friend, you have asked quite a lot of very, very interesting questions. So let me unpack that on several things. The first is traditionally, even if you go back to the Lydians, who first came up with currency notes almost 3,000 to 4,000 years back, they've been always people who were unbanked. And the reason why they were unbanked is because the banking system or the economic system has got costs. Somebody has to pay for all the people. Somebody has to pay for the technology. Um, After the global financial crisis, because of the increase in rules and regulations, which were, I mean, you can debate about it, but it increased the cost of banking business or trading or investment business. As soon as the cost increases, somebody has to pay. Now, one of the big implications of, for example, what happened in the global financial crisis was that two things came up horribly. The first thing is that the cost of servicing the poor shot up. It absolutely shot up, and I'll come back to that, or I'll explain that in a moment. As you said, you were talking about somebody transferring, let's say, 1,000 rupees from Dubai to India. Now, if we say 1,000 dirhams, and there's a poor laborer who's living in the labor camps, he has struggled, he's earning maybe 900, 1,000 dirhams per month, and he saves up for 3 4 months, and he's got, let's say, 1,000 dirhams to send. Now, as you mentioned, uh, the cost of transactions is quite expensive. First, he's got to come to the exchange house, and the exchange house over here will take a cut. Then you are going to have the FX rate. Then it will land in the correspondent bank in India, who's going to take their cut. Then it's going to go to his mother's, who's living in Jharkhand, their bank account. That poor girl has to go to the bank and then queue up for hours, establish her KYC and credentials, and then withdraw the money. And then the local banks will also take their cut. So now you've got 3 4 things. For 1,000 dirham transfer, you have got hours and hours of physical movement from home to the bank to the home. A huge amount of information is required. People have started to take 4 5 different cuts. So by the time Mrs. Shukla gets that money in Jharkhand, instead of 1,000 dirhams, she'll be lucky if he gets about 940, now maybe 950 dirhams. And that is a very expensive thing for Shuklaji, who's a gardener in somebody's villa. The second problem that has happened, and lots of stats are out there, is that the SME financing gap has shot up. It is a huge problem. Corporate banking for small and medium scale enterprises has become very expensive. I'll give you an example. To do a KYC AML for a corporate can cost anything between 10,000 US dollars and it can go up to 30 to $50,000. I'm not going to make any money out of a SME if I'm a bank, if I've got to spend that much. I can't. Across everything, provision of current account, bit of lending, bit of overdraft, a little bit of FX, bit of this and that will hardly get me maybe about $5,000, $8,000 in fees. Um, and the amount of deposits that they're going to give is also minuscule. So they are simply unprofitable. So what has happened is that the vast majority of micro, small, and medium scale enterprises are getting either at worst non-banked or underbanked. The other problem that is happening, which is a really bad thing, which we will find out, which we are finding out, is that employment is dropping across the world. The small, micro, and medium scale enterprises are the real engine for employment, and we are not able to do that. So I'm giving a very broad explanation, but what happens is that look what a stablecoin can do. What a stablecoin can do is that you actually don't have to go anywhere. You will be sitting in a labor camp. Mrs. Shukla is at home. Both of them have phones. The money gets transferred like that. The KYC AML that I talked about, again, is reduced substantially because quite a lot of jurisdictions allow, for example, digital onboarding. And KYC for electronic checking, quite a lot of them are digitized. And finally, remember what is happening is that the vast majority of stable coins are expressed in US dollars. So you are removing what? The FX risk. Now, I know you are going to transfer it at some point in time, but quite a lot of legs are cut out. So from an efficiency perspective, from an unbanked or underbanked perspective, from a convenience perspective, from a return perspective, all those things are good. And I haven't talked about the last thing that is going to substantially make a difference. Stable coins, if you hold it right now, if you hold cash, quite frequently you are not going to get almost anything in your hand. I mean, if you keep cash in your home, nobody gives you money. You can obviously keep it in your savings account, but the interest rates are like that, minuscule. But if you hold stable coins and they are yield bearing, you get the money market rate. So what's happening from a banking perspective, they are faced with 3, 4, what I would call as existential challenges. One is that the operating model definition has changed. You have to be working 24 hours a day, 7 days a week. Second thing is, I need to transfer money instantaneously. Third thing is, you need to give an attractive rate of return. Fourth is, all these unbanked customers have suddenly become a huge revenue source which somebody else will take it. So once you put all these things together, banks have woken up to the fact that the traditional way of working is no longer appropriate. And I'm sure you would have seen in your research, companies ranging from JP Morgan to Citi, and locally, if you look at Fab, almost everybody has already announced plans or have issued stable coins or have set together teams that are working on this. They have to change, my friend. Otherwise, the floor under their feet is gone.
So what it's sounding even better and better. Besides what we discussed earlier, you're saying it's frictionless and it'll also democratize banking as we know today. So an obvious question, Bhaskar, what is the business model to deliver all these pluses and still be cost effective?
So, when we were talking about this session, I think I mentioned that one of the things that I keep on talking about that banking will stay. Banks, I'm not sure. So the business model here comes from if I am a stablecoin issuer. Look, in a way, banks are also issuers of we were talking about fractional banking. I take in $1 as deposit, and then magically I produce $9 more because if I say my bank's capital should be 10%, it's actually not 10%, it's slightly less, but for argument's sake, let's say 10%. I can lend up to 90%, $9 more. So for $1 of a deposit, I can lend 9 more. Where is this money coming from? It is magic money, right? So in a way, I am also issuing, but now what's happening is that I've got to keep more capital. A stablecoin issuer is again a financial institution. It's a new type of a bank. It doesn't take deposits. It does take the underlying asset, but it gives you a coin that represents that. So how do I make money? Right? And this is where you need to rethink how financial institutions or a new age bank will work. For an existing bank, it is for protection of your existing business. I can do business with you on fiat. I can do business with you on stable coins. So I keep my clients with me. But what about somebody who's not a bank? They are coming in. And we have got, I would estimate about 60 stablecoin issuers in the UAE. Where are they going to make the money from? Right? Very good question. Number one, they rely on volume, right? And if I have volume, and remember, I have to have one-to-one backing. So for every one stable coin, I need to have $1 or $1 equivalent of, well, fiat currency. But I will take a tiny spread when I lend it out or when I use it. The second is I've got transaction fees. I will use transaction fees, but it's going to be a fraction compared to the traditional ways. The third thing is I can lend stable coins to others who want it as collateral, and then I'm going to charge them a lending fees. But the magic, my friend, happens in the network effects. Let me give you an example, right? The network effects kick in insofar as I'm a bank and I'm lending money and I'm also taking deposits. Or I'm a asset manager, servicing company, which has got quite a lot of funds and investors. So instead of transferring and doing investments in US dollars or rupees or dirhams, I do it in my own coin. Consequently, I start earning spreads on both sides. So the network effects kick in, and the network effects, whoever wins the network effect is going to win the deal. So that is the reason why everybody wants to get out there as soon as possible. They are starting to find niches. It could be that, for example, we could have a pharmaceutical coin, right? I'll give you an example. I have two firms. One of them is a food and beverage firm. Another one is a whiskey firm. And I'm encouraging both of them to first of all take in payments in stable coins and cryptos, but also I'm encouraging them to issue their own stable coins. So every time you buy, let's say, some fruit or a biryani or a kebab, okay, they will give you stable coins as something like loyalty, and you can use it to buy their own product. But then on the whiskey side, you do the same thing, okay? And now you start bringing both of them together. So guess what? If you bought whiskey as well as biryani from two completely different vendors, but because you are doing one transaction, both of them will give you a little bit more. So what I'm saying is that the synergy increases. People start doing more business between the food and beverage biryani maker and the whiskey maker. So the combined piece is bigger. So this is where the amazing bits of stable coins come in. And I haven't even talked about the sheer advantages that the smart contracts provide.
So tell me something, Bhaskar. From all that you have said, it's like you said, a magic coin, not just a stable coin. But what about the downside risks? So,
Hmm?
and especially from a regulator's point of view, what is the kind of oversight and the kind of skill sets or capacity that they will have to create to see such a framework where the speed of transaction is going to be extremely high, something which you have not witnessed so far. So, and multiple from what you just said, you can have synergies, so which means corporate restructuring can happen. So, how does a regulator approach this, and what are the downside risks?
So I'm speaking as an ex-regulator and also somebody who's worked in banks. Uh, there are, and also in the government. Uh, from a government perspective, there are a few things that will worry me. The first is obviously the banking system is going to get disrupted. And you know what? You play around with banking system at your peril. It can really, really screw up your economy, something bad. So that is one thing, if I was in the government, would keep me awake. The second problem that has already been articulated by people like the European Union, European Commission, or people in emerging markets or China, is that the vast majority of stable coins are denominated in US dollars. Going back to your first question about the Genius Act, the biggest reason why it was such a massive disturbance in the force was that the most liquid, widest, most developed market is now stablecoin enabled. That basically means that the dollarization of the world is going to accelerate. Now, why am I saying this? I will just unpack that a bit because I think this needs to be understood very carefully because it will also tell you how countries would respond. And in many ways, they are a bit impotent because they can't do anything about it. Both of them are dangerous things. Uh, First is that because the dollar is so liquid, there is a vast array of instruments, liquid instruments. There is debt, there are buyers and sellers. The US government itself issues a lot of debt, and it's the highest rated market, all that nice stuff. It is not so in other countries. I cannot actually go to quite a lot of emerging markets and say, do you have a liquid cash or money market sector? No, they don't. So I cannot issue a stable coin in that currency. Why? Because you just don't have enough liquid assets. It might be overpowered by the banking system, for example, that you see in Europe. So this is this is the fractional banking. I can't issue a stable coin on the $9 that I talked about. I can only issue on the hardcore currency, and that's not there at much. So what's happening is that because of the rollout of this, you have a challenge that monetary sovereignty is a bit of a question mark that quite a lot of countries have to deal with. So that's on the government level. The second piece that comes up is on the regulatory level. Now, traditionally, when you're talking about a regulator who's looking after banks or insurance companies or asset managers, it was slow. Things would move slowly. Nothing much will change. I just have to look after them. Not much rule book changes. I'm okay. Now comes up all these things. Now I'm worried. Business models are changing. Transactions are happening immediately. These things I can't go and touch. Somebody might be sitting in some other country and issuing a stable coin, and my people are using it, right? Quite a lot of stable coins are going to be issued from the US, and they might be used in, for example, India or China or places like that. If somebody has a problem and they don't get the money back, who are they going to go and complain? The local regulator can't do that. So he has to think about it, right? He has to also think about the fact that the speed of response for consultation papers or issuance of rules and regulations, uh, that is a challenge. You also need to worry about the fact that do I have people who understand this? In a traditional regulator, people would spend lots of time in the industry and then they would come in and then sort of, that transfer happens as it should, because regulators need to know what the industry does and the industry needs to get the regulators. But this is a nascent market, hardly 1 or 2 years old. The business models are evolving at the speed of, light. So, do I have the people who understand it? And if I become too strict, then it will go somewhere else. If I'm too lax, then problems happen. So, from a government perspective and from a regulatory perspective, you have to worry about internals. Now looking at the stable coins, these are the things I need to worry about. I need to understand whether your business model is good or not. What is your strategy? The second thing I need to worry about is your management good, the mind and management? The person who's issuing the stable coin, I need to look into his eyes and say, are you a good person? Are you a trustworthy person? Forget about the stable coin. I'll come to that in a moment. Are the people right? Are the management good? Third thing I need to worry about, are your processes good? Can I trust them? Are they going to break? Are they okay? Then I need to look at your technology. Is it good? Is it breakable? Do you have a good CTO? Have you got good operational risk? I need to worry about the people who are going to be operating. I need to worry about the reserves that you have got. Are you managing them properly? So, to summarize, governments and regulators need to look at internally and pretty substantial questions at that. And then the regulators need to look at stablecoin issuers very fast, very quickly, very deeply, and you cannot be relying on a regulatory regime which relies on somebody sending you a report every quarter or somebody coming in and meeting you once every 6 months. These things can go haywire literally overnight. So your monitoring has to be online, real time. Think about it. Previously, you could do with paper files. Now, regulators must have a NASA-like control function. You know, the other thing that I explain is when you go to, for example, surgery or things like that, you're hooked up to all kinds of things, and you got a monitor which says this is your blood pressure, this is your pulse, and all those things. That is the kind of things regulators need to have, an online, real-time dashboard of everything that is happening.
So, Bhaskar, this is a veritable nightmare for any regulator. We're reaching the fag end of our conversation. Quickly, I wanted you to respond to the fact that all that we have discussed suggests that the stablecoin revolution has begun. But in back home in India, the Reserve Bank of India is a very conservative entity, rightly so. Now, and overall, the government has been rather reluctant to the idea of stable coins. They've been looking at the downsides more than the positives. So, what does it mean for countries like India who are on the fence right now? Can they afford to sit out of this revolution?
So obviously, I can't speak on that, but I am very ambitious. I know that India has an awesome opportunity to be on top of these things. Why am I saying that? We are, in terms of the openness of the market, the leader. Our capital controls are much weaker than what they were. We have huge remittance flows. We have huge people flows. People in India know how to manage to set up an electricity power plant. We know how to handle bad infrastructure. We know how to manufacture buckets. We know how to do lending. We know how to do credit. India can be absolutely a world leader when it comes to digital. Heck, we are supposed to be the IT capital or the services capital of the world. We have perhaps the best the payment infrastructure in the world. If we layer it with stable coins, literally what I'm saying is we can't compete with a US dollar financial system. But what we can do is to compete with our domestic economy and emerging markets. There is no reason why India's, let's say, stable coins based upon the Indian rupee and our technology stack can literally go to other governments and say, we will help you. You have your fiat currency, but we will run your stable coins for you. We shouldn't be defensive. We should be ambitious. India has an awesome opportunity. You have seen what we have built of the payment stack. Just extend it out to support stable coins. And then everything is going to come to us. All the global South business, that is one place for us to be. I think there is huge opportunities. And currently I'm working on 3 or 4 options. In fact, I'm going week after next to meet a couple of regulators, and I'm going to be proposing few things that will use stable coins for this. So I'm personally very excited, and I'm personally investing quite a lot of my time, money, and energy into seeing whether we can do more with stable coins there.
Great. Thank you so much, Bhaskar, for this conversation. Very insightful and illuminating.
Thank you very much for inviting me, and thank you for taking the time on a Saturday. And wishing you and all your readers a very good weekend.
Thank you, Bhaskar. It's very clear that from what Bhaskar laid out before us, that the Genius Act has actually set in motion a formal adoption for stable coins, not just in the United States, but across the world. One of the fallouts is that the hegemony of the dollar, which several of the BRIC countries fear, is here to stay if stable coins gain the kind of bandwidth that everyone sees in it. So, like the artificial intelligence, this is another tsunami in the making for the world economy. Once again, this is an option that no country can afford to sit out. It has to be proactively involved, especially in not only creating the infrastructure, but in also influencing regulation. Particularly true for India. So the challenges are there, but the opportunity too. But like I say, forewarned is forearmed. Thank you for watching. Don't forget to subscribe to StratNewsGlobal.Tech on YouTube. Hit the bell icon so that you don't miss any updates. And please to share your thoughts, ideas, and suggestions with us. I'm available on X at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.